Treasury yield flirts with 3%. We continue to see it, and one veteran bond fund manager has rolled back his year-end forecast. Bryce Doty is with CIT Investment Partners. Welcome to the program, Bryce. I mean, how come you don't see the 10-year yield getting to 4% anymore this year? You think we're going to sit around where we are right now?
Right. Early in the year, it was surprising how quickly the 10-year moved up in yield, and it looked like 4% was a real possibility. And then along came the tariff talks, and that evolved into a trade war, and so that suppressed yields quite a bit. And so without any clarification or resolution to the trade wars, it looks like 10-year is a little suppressed for now. And so maybe it'll be next year when we see 4%. Maybe we only get to 3.5% by the end of this year. What that does is it really accelerates the point at which the yield curve gets inverted. We were thinking that might be a year off as well, but now if the 10-year stays so low, stays so suppressed, and you still have the Fed raising rates a couple more times this year, combined with massive amount of Treasury issuance on the short end by the Treasury Department, and then the icing on the cake, or the nail in the coffin maybe, is the Federal Reserve reducing their demand for bonds by a couple $100 billion yet this year, most of it in that 2 to 5 year part of the curve.
So I want to unpack a little bit of that. I mean, a yield curve inversion is not a small thing. That's something that a lot of traders have been very focused on and worried about, frankly. So can you talk me through, you mentioned it briefly, but when do you think that happens? And if it does, then what kind of damage are we looking at?
Right. I thought it was going to be a long ways off, but the 7 and 10-year yield is already within 4 basis points of each other. The 2 to 10-year spread is only 30 basis points, so it could happen a lot quicker than we originally expected. I see that the economy is so strong. I mean, look at the data we've just seen in the last week, and we're probably going to look at a strong employment report on Friday. Tomorrow, the Fed, I'm sure, is going to reiterate their belief that the economy is very strong, indicating at least 2 more rate increases this year and probably 2 to 4 next year. So that's going to continue to drive up yields on the short end. The balance sheet reduction is accelerating. We're up to $40 billion a month, which changes to $50 billion a month of demand going away for bonds by the Federal Reserve. The Treasury Department has over $500 billion worth of bonds left to issue in the next 6 months. So that almost all of that is with 5-year maturities and shorter. Now, normally a yield curve inversion is really bad for the economy, but I think people have it in reverse. Usually it's the outlook for the economy starts to sour, and that's what causes traders and investors to drive yields down in anticipation that the Fed at some point is going to need to cut rates. It's not the inversion itself that causes the recession, it's the faltering economy that will cause that. But we don't have anything like that this time. We have the economy booming. We have Jerome Powell, head of the Fed, predicting that tax cuts will benefit the economy for at least the next 2 to 3 years. And so what's happening now is an inversion caused by these technical factors that we've never had before. We've never had a Federal Reserve with $4 trillion trying to unwind it.